Welcome to ETVBharat. Today we are going to discuss the recommendations of 15th Finance Commission with the chairman, Mr. N.K. Singh. Sir, welcome to ETVBharat.
Thank you.
Sir, some people say you hold the most difficult job because not only you needed to divide the resources between the center and states, but among the states themselves. That is very difficult. The horizontal devolution is very difficult. So, how challenging it was for you to divide the money between the center and states and between the states themselves?
Well, I must say that all finance commissions, from their very inception, from 1951 onward, have faced a similar challenge, namely that under the Constitution, the right from the first Finance Commission, and I will not mention the interim Finance Commission between 1949 and 1951, but right from the first Finance Commission under the chairmanship of K.C. Niyogi, all finance commissions have to, under the Constitution, discharge the two critical responsibilities of one, dividing the resources, that is the net divisible pool between the central government and the states, and the second, that having decided how much will be given to the states from out of the gross tax revenue and this thereafter deriving the net divisible pool, what formula should be used for its interstate distribution among all the states. In our case, 28 states, earlier finance commissions, 29 states, because we assigned certain grants to the union government, because for the two union territories of Jammu Kashmir and Ladakh, since the number of states have now come from 29 to 28. So this has been a classic function. In addition, after the constitutional amendment, it has become a practice to also devolve large resources to the third tier, namely urban local bodies, to municipalities, and to panchayats. And the last one, namely for the disaster management, after the Disaster Management Act of 2005, for the National Disaster Management Fund and for the State Disaster Management Fund. In addition, of course, and this is the differentiating characteristic. So the first two, the vertical and the horizontal, is common to all finance commissions. Thereafter, after the constitutional amendments, the third tier also represented a kind of an important responsibility, and of course, the disaster management. In addition, every finance commission have their own unique terms of reference. So the president this time chose to assign us many more areas on which they wanted our recommendations, which is spelled out in a rather unique terms of reference in more ways than one. Why unique? Because the number of areas on which they wanted our views on performance-based incentives, on monitorable criteria, on, for instance, a unique terms of reference, namely for defense, which was for the first time only unique to the 15th Finance Commission, and also in respect of some sectoral allocations, which they also sought our recommendation. And last but not the least, the challenge of, for the first time, after 1970 up to 1974-79, the Sixth Finance Commission was using the population census data of 1971. For 40 years, the 1971 data was being used. We were the first one to be asked by the president to use the census data of 2011. And as I said, this is the broad architecture. And of course, within that framework, the issue of the fiscal consolidation roadmap and the strategy on debt and on fiscal deficits during this problematic period for 5 full years, because we are one commission which has given recommendations or awards for 6 years. One, the current year in the first report, which we gave for 2021, and thereafter for full 5 years during times which are uncertain And that is why the Finance Commission captioned this time Finance Commission in COVID times.
Sir, I wanted to ask you, the commission was constituted in November 2017. And
Yes,
before you could give your report, there was a once in century event, the outbreak of COVID-19 global pandemic. And
right,
before we entered into lockdown, you must have completed a substantial part of your discussion consultation with the states and other stakeholders. So how
right.
challenging it was for you to completely revamp to factor into the changed scenario?
So there were three important factors which came, so to say, which we had not anticipated. One, as you said, that the once in a century, if not longer, a global pandemic, of which we are also a very important victim, so to say. So this needed a recalibration of the likely revenue buoyancy, the revenue numbers, both for the center and for the states. And this time, because we have given a separate volume, namely volume 4, especially for the states, we wanted to give a unique disaggregated path for each state. So, recalibrating the likely revenue numbers and recalibrating the inescapable revenue expenditure of each state
Mhm.
based on its unique circumstances was one type of a issue. Also, we had to factor in that the additional fiscal pressures on the central government from the viewpoint of both life, namely, and I'll come to the life, and livelihood,
Mhm.
we had to reckon for the fact that the central government's fiscal pressures would be certainly far more than they were earlier. And finally, the general decline in the overall revenues affecting both the central government and the state government, particularly the GST, which in which the state governments have a vital responsibility. So I said I'll come to life a little later because for the first time we
Mhm.
have devoted in the Finance Commission's report an entirely separate chapter
Mhm.
on health
Mhm.
and the need for recalibrating the expenditure on the health sector,
Mhm.
particularly in respect of the engagement of the third tier, also posed an important obligation. So, in many ways, we had to go back to the drawing board
Mhm.
to redraw the fiscal and the debt roadmap for both the center and the states on account of the factors on which I have just commented.
Sir, in your report, you have taken 6.5% as a fiscal deficit, you anticipated. But in the budget, we see the fiscal deficit has gone up to 9.5%. In fact, when the revised numbers come next year, it could be even higher or even in two digits. Uh, so, do you think in such a situation, I'm going slightly beyond the recommendation, is it desirable to achieve 4.5 within 5 years? Is it desirable to achieve?
You mean, is it feasible to achieve?
Fiscal deficit,
Not
is it
desirable.
feasible to achieve?
Is it feasible to achieve?
Mhm.
So, first, I must comment on your first point that why have the fiscal numbers for the central government's overall deficit of 9.5 look so misaligned with the numbers which we had projected?
Mhm.
Now, one of the things which you must recognize is that although I had the privilege to chair the last FRBM Fiscal Responsibility Management Committee, whose
27.
recommendations were accepted in 2018, I must say that one of the things which were of great concern to the FRBM committee, and this is an equal concern to the Finance Commission, was the need for transparency and credibility of fiscal data.
Mhm.
So, what had happened in the past that through clever financial engineering, to use a polite word, both the states and the central government were doing off budget borrowing, uh, incurring contingent liabilities, having guarantees, creating parastatals, and that this had been adversely commented upon by all investors, rating agencies, and domain experts. So,
Mhm.
part of the reason for this huge bump up from the anticipated figure to the figure presented by the finance minister represents greater transparency and credibility in accounting processes itself of reckoning the true numbers of fiscal deficit and as a consequence, therefore, debt. Now, your second question is about the roadmap of whether the terminal number which they have projected for themselves is higher than the number which we have projected for the central government. It's about a half percentage point higher. So I think that there are currently serious uncertainties on the recovery process. The pandemic has not run its course. There could be serious unanticipated fiscal pressures as we get out of the pandemic and as we begin the recovery process. So they have sought a leeway for another 0.5% beyond the numbers which we had indicated. I mean, that is perfectly understandable. That is why, given all these uncertainties, the Finance Commission has recommended the constitution of an intergovernmental high-powered group, which will go into the future roadmap of the fiscal consolidation process of the general government. Namely, it is only meaningful, which you know, if the numbers include the states and the center. Intergovernmental we have used because it includes the state governments and the central government. And that is our recommendation contained in the Commission's report, on which on the ATR presented, the government has said that these recommendations would be examined separately, namely, they would have to be considered in great detail.
Sir, I have spoken to state representatives in past, and there is a continuous demand that from the divisible pool, it should be 50-50 between the center and the states. 14 Finance Commission, as you know, recommended 42% devolution. You have kept it at around 41%. So how difficult it was, because there is a recurring demand from the states, and states complain that why center has more money despite spending less. You know that there is a vertical gap between the center and the state. Center collects nearly 2/3 of the revenue and spends nearly 1/3, and states collect only 1/3 and spend around 2/3. So there is a continuous demand from the state, and they complain that because why center has more money, because the state finance commission gives the center more money. So how difficult it is for you or for any commission to reconcile to this fact, because they are weaker in terms of revenue collection.
So let me answer this question in two parts. In part one, let me say that anecdotally, no finance commission, present one and all previous ones, when visiting all the states, would not have received a similar request that please increase our outgo, please increase our devolution from the divisible pool. We also similarly faced this request from all state governments that yes, 32 to 42 was a very significant hike, but then Planning Commission was abolished, various other things happened and so on, and that therefore needs to be calibrated upwards. Similarly, as far as the central government is concerned, they were already reeling under the impact of the increase from 32 to 42. Whatever be the actual data, optically in their view, it was a 10 percentage point increase from the usual pattern prior to the 14th, which was a more incremental increase, 29 going to 32 and 33 point, and then so on. But this was a quantum change from 32 to 42. So the central government would have felt somewhat more comforted if this had been recalibrated in a somewhat downward direction. So there were both these opposite points of view. We preferred the path of stability and continuity because we felt that bringing it downwards would send, perhaps may not be appropriate in our judgment, looking at the fiscal pressures of the states, and that raising it upwards at a time like this would be also not be fair to the demands and the fiscal pressures of the central government. So we preferred the path of stability and continuity, and in cognizance of the fact that no finance commission in the past has moved except in one direction, namely the direction of an upward increase in the divisible number. And so the best we could do under the circumstances is to honor stability and continuity and predictability by keeping it at the same level at the 14th. On the point of the fact, now you see, the fact remains that you know very well that there are three important concepts. There is the gross revenue receipts, what is known as the GRR. Now, in our calculation, the gross revenue receipts based on our modeling for the 5-year period is 153.4 lakh crores. Take out of this are things which are not divisible at all: the dividend of the RBI, the dividend from the public sector undertakings, the user charges, the interest realization from outstanding loans of the central government. And this 153.4 lakh crores comes to what is known as a gross tax revenue, which was 135.4 lakh crores. Right? Now, take out of this the cess and surcharge and the cost of collection, and the divisible pool then comes to 103 lakh crores for the 5-year period. The 41%, which we have given out of the divisible pool, comes to about 42 lakh crores, right? Plus, we gave a recommendation of 10.5 lakh crores by way of grants, namely over 4 lakh crores to the third tier, 4.22 lakh crores. We have given a revenue deficit grant of 2.94 lakh crores. We have given for disaster management 1.22 lakh crores. The state specific and the sector specific are still being considered, but these have been accepted. So if you add the 10 lakh crores to the 42 lakh, it comes in the ballpark of a more even balancing out of the divisible pool of 103 lakh crores, significantly more than the 41%. Plus, I have not added that the central government each year spends over 3.5 lakh crores on the center's contribution to centrally sponsored schemes whose benefits really go to the state. And therefore, if you add all this, this does not look to be a very uneven balance. And even without adding the centrally sponsored schemes, therefore, we believe that we are somewhere in the ballpark of even balancing from the divisible pool of the center and the states in a manner which we felt was reasonable and appropriate. Now, the more difficult question is that out of the divisible pool, should cess and surcharge be included or not?
Yeah, in fact, I was coming to this point.
So please come to that point, because then I need to comment on that, because that's a very important question.
States complain that the share of cess and surcharges in the last 10 years, it has constantly gone up in the total revenues collected by the center. And since cess and surcharges don't form of the part of the divisible pool, so they have been deprived of their share in this thing. So can you explain on this thing, sir?
Yes, I will. I think that the states are not wrong, that the cess and surcharge as a percentage of the GTR, or the gross tax revenue, in 2010 and 11 was 10.4%. That in the BE of 2021 has gone up to 19.9%, which is almost close to 90% increase in the period 2010-11 to the period in the BE of 2021. So technically, the states are, of course, right in saying that the burden of cess and surcharge has significantly crept up in the period 10 2010-11 to the BE of 2020-21.
Mhm.
Right. Now I have three small observations to make. First and foremost, the issue of cess and surcharge is outside the ambit of the Finance Commission because after the 80th constitutional amendment in the year 2000, the provisions of Article 269 and 270 of the Constitution specifically excludes the cess and surcharge from the calculation of the divisible pool. So this subject is outside the mandate of any finance commission. This is a subject not for finance commission, but for the parliament to consider, or whether, given the concerns of the state and based on a consensus of all stakeholders, they would seek to amend this constitutional provision which keeps cess and surcharge out of the divisible pool. But please also remember the background of the 80th constitutional amendment in the year 2000, that prior to that 80th, the divisible pool had a different connotation. When the Finance Commission began, what was being divided in the earlier phases was percentages of income tax. Later on came percentages of excise and different variations and mix of excise and income tax. Thereafter, it was only in the year 2000, with that constitutional amendment, that the definition of the divisible pool included all taxes, which means corporate taxes, was brought fully into the thing. Tariffs were brought in fully into the divisible pool. So the definition of the divisible pool got substantially enlarged after the 80th constitutional amendment in the year 2000. The composition of the divisible pool, therefore, and the 80th constitutional amendment changed. It enlarged the ambit to include all divisible resources, all tax revenues, including corporate taxes, and the realization of some customs duty as part of the divisible pool. So the definition of the divisible pool was enlarged. As part of that process, there is a specific provision in the Constitution which kept out cess and surcharge from out of the divisible pool. Therefore, the appropriate forum to discuss this would be based on a wide-ranging consultations among all stakeholders for Parliament to take action. This is a subject outside the purview of the Finance Commission. However, we have taken note of this issue in this Finance Commission, as earlier Finance Commissions have. And if you look at paragraph 3.63, paragraph 3.8, paragraph 4.25, paragraph 4.26, they are all comments on the rising incidence of cess and surcharge. And we have done one better. We have done what we could do, that recognizing that currently cess and surcharge is close to 20% of the divisible of the GTR, we have calibrated it downwards to 18.4%, which means we have, in a way, while recognizing the revenue expenditure and recognizing the likely tax policy, placed it at 18.4 instead of 20, a signal for a downward direction. One final comment. Final comment on this is that please do not forget that in this close to 20%, it includes the compensation cess. It includes that proceeds of compensation cess entirely go to the states, because the compensation cess is only being realized for purposes of enabling the states to have the guaranteed 14% up to the period of 5 years from 17 to 2021, July. And any past liabilities to be also equally calibrated from the period of the compensation cess, which has now been extended to an appropriate period. The benefits of that are entirely go to the state governments. And if we therefore recalibrate the numbers around 20%. This compensation cess accounts, in our view, around 3%, around 3.3%. If you increase that, because that is benefit going to the states, this will come around 16% or so. So the real argument is the argument of the increase from 10.4 not to 20, but 10.4 to around 16% or so, which rightly the states also perceive to be somewhat unacceptably high.